Hey everyone, and welcome back to Financial Essentials. Think about it, most of us use a bank account almost every single day. We swipe our cards, pay our bills, and get our paychecks deposited. But do we really understand how they work? I'm talking about the difference between a checking account and a savings account. It seems simple, but getting this right is the foundation of managing your money effectively. Which one should hold your cash, and why does it even matter? Today, we're going to break down everything you need to know about checking versus savings accounts so you can build the perfect setup for your financial life. This isn't just boring bank talk. This is about making your money work smarter for you. So let's dive in. First up, let's talk about the checking account. This is your financial workhorse, the central hub for all your daily money activities. A checking account is specifically designed for spending. Think of it as your cash flow command center. This is the account you use for all your regular expenses, paying your rent or mortgage, buying groceries, covering your monthly bills like electricity and internet, filling up your car with gas, and handling all those little subscriptions that add up. When you use your debit card at a coffee shop or a store, the money comes directly out of your checking account. Because they're built for frequent use, checking accounts typically allow for unlimited transactions. You can swipe, tap, and transfer as much as you need to without hitting a wall. They almost always come with a debit card for easy access to your funds, and they support features like online bill pay, which makes managing your recurring expenses a breeze. The one major trade-off? Checking accounts usually pay very little to no interest. The money sitting in there isn't really growing. Its purpose isn't to make you richer. Its purpose is to be accessible and ready for you to use whenever you need it. So remember, checking equals your daily financial hub. Now let's switch gears and talk about the savings account. If the checking account is for spending, the savings account is for storing. Its entire purpose is to hold money you don't plan on touching for a while. This is the perfect place for your emergency fund, that cushion of cash set aside for unexpected life events, like a car repair or a medical bill. It's also ideal for short-term goals. Are you saving up for a vacation, a down payment on a car, or new furniture? A savings account keeps that money separate and safe. A lot of people also use them for what are called sinking funds, which are small savings pots for predictable but irregular expenses, like holiday gifts or annual insurance premiums. The key features of savings accounts are almost the opposite of checking accounts. First and foremost, they pay interest. Your money isn't just sitting there, it's slowly growing over time. This is the bank's way of rewarding you for parking your cash with them. To encourage you to actually save, these accounts often have limits on how many withdrawals you can make each month. This little bit of friction makes you think twice before dipping into your savings for a non-essential purchase. And here's a pro tip: look into high-yield savings accounts. These are often offered by online banks and can pay significantly more interest than the savings accounts at traditional brick-and-mortar banks, helping your money grow much faster. So let's put it all side by side and highlight the key differences. It really boils down to their primary function. A checking account is for spending and managing your bills. A savings account is for storing your money and letting it grow, even if it's just a little bit. This leads to the next major difference: accessibility. Checking accounts are designed for high accessibility with unlimited transactions. Savings accounts are designed for lower accessibility, often limiting your withdrawals to encourage you to leave the money alone. And of course, there's the interest. Checking accounts typically offer little to no interest, while savings accounts are designed to earn you interest. The bottom line is that they serve two completely different, but equally important roles in your financial life. You're not meant to choose one over the other. In almost every case, you actually need both to manage your money effectively. Okay, so you need both. But how do you actually use them together in a way that makes sense and helps you reach your goals? Let's build a smart automated system. It starts with your paycheck. Have your direct deposit go straight into your checking account. This is now your home base. From this account, you'll pay all your bills and cover all your regular budgeted spending for the month. Next, set up your savings. The most important thing is to automate it. Don't rely on remembering to move money over. Set up an automatic transfer that moves a fixed amount from your checking to your savings account every week or every time you get paid. This is where it gets powerful. Have a separate savings account for your emergency fund. This money is sacred. It's for true emergencies only. Then consider opening one or more additional savings accounts for your specific goals. Saving for a trip? Create a vacation fund account. Saving for a house? Open a down payment account. Most online banks let you create these sub-accounts and give them custom nicknames. This psychological trick is incredibly effective. Seeing an account labeled Hawaii 2025 is way more motivating than a generic savings account number. By automating these transfers and labeling your accounts, you make saving effortless. It happens in the background, and you're building wealth without even thinking about it. Now that we know the right way to use these accounts, let's talk about some common banking mistakes people make. These are the little things that can silently drain your wallet and hold you back financially. The biggest mistake is keeping all of your money in one checking account. If all your cash is in your spending account, it's way too easy to spend it. Plus, you're missing out on earning interest. You're essentially letting your savings lose value to inflation. Another common error is racking up overdraft fees. This happens when you spend more money than you have in your checking account. These fees can be incredibly expensive and are completely avoidable with a little bit of planning and maybe setting up low balance alerts. Also, be mindful of subscription creep, those small monthly charges that you sign up for and forget about. They can really eat into your checking account balance. A huge mistake is not having a separate, dedicated emergency fund. When your car breaks down, you don't want to be scrambling or putting it on a high-interest credit card. And finally, paying unnecessary bank fees. Many banks charge monthly maintenance fees if you don't meet certain requirements like a minimum balance. Look for free checking and savings accounts. They are widely available, especially at online banks and credit unions. Fixing these small mistakes can make a massive difference to your financial health over time. So, who needs what type of account setup? It really depends on your personal financial situation and your goals. For the average person with a steady job and regular paycheck, a simple setup is often best. One checking account for bills and spending, and one high-yield savings account for your emergency fund and other savings goals. That's a great foundation. If you're self-employed or a freelancer with a regular income, you might benefit from a more detailed system. You could use one checking account for business expenses and another for personal spending. Then you could have multiple savings buckets or accounts, one for taxes, one for your emergency fund, and others for personal goals. This helps you manage your variable income and make sure you're setting aside enough for taxes. And what if you're focused on building long-term wealth? Your setup will evolve. You'll still need that basic checking and high-yield savings account combo for your short-term needs and emergencies. But you'll also want to add investment accounts to the mix, like a Roth IRA or a brokerage account. This is where your money can really start to grow significantly over the long term. The key takeaway here is to match your bank account structure to your specific life stage and goals. Your system should support your financial journey, not complicate it. Feeling a bit overwhelmed? Don't be. Getting started is actually very simple. Here's a quick 2-step setup plan you can implement right now. First, open the right accounts. All you need to begin is one checking account and one high-yield savings account. Look for options with no monthly fees and no minimum balance requirements. You can find great options at online banks or local credit unions. Step 2 is to set it up for success. Once your accounts are open, turn on automatic transfers to move money from your checking to your savings every payday. Set up low balance alerts on your checking account to avoid overdrafts. And finally, hook up your regular bills to your checking account's bill pay feature. That's it. It's simple, but it's incredibly effective. At the end of the day, your bank accounts are tools. They should be working for you, helping you organize your finances and reach your goals, not working against you. Getting this foundation right is one of the most important first steps you can take toward financial wellness. Thanks for watching. If you found this helpful, make sure to subscribe to Financial Essentials for more simple breakdowns of money basics. We'll see you in the next video.